In this video, we're going to discuss installment sales. So, PFRS 15, which supersedes PAS 18 as the revenue recognition standard, does not specifically deal with installment sales. This installment sale is not in accordance with the recognition principles provided for by PFRS 15. These installment methods were adopted from US GAAP. You have FASB, Financial Accounting Standards Board Concept Statement number 5, states that companies cannot recognize revenues as being earned until they are realized or realizable, and the company has substantially completed what it needs to do in order to be entitled to payment. Revenue can be recognized at the point of sale, before and after delivery, or as part of a special sales transaction. So if the sales price is not reasonably assured after delivery of the product or service to a customer, the company may choose to defer recognizing revenue until cash is received. Generally, there are two accepted ways to account for these transactions. So you have installment sales method and the cost recovery method. For discussion's purposes, we're going to include the gross profit method. However, it's not considered as acceptable because it is contrary to the conservatism principle. So we will compare gross profit realized at point of sale and gross profit realized after the point of sale. Not in all circumstances that collection after the point of sale is automatically deemed as installment sales. For example, a transaction of a sale on credit, we record it not by debiting installment receivable but rather simply debit accounts receivable and credit sales. So not all transactions not all transactions where payment or collection is deferred is automatically classified as installment sale. So first we have gross profit realized at point of sale. So for example, you have month 0, month 1, month 2, month 3, and month 4. So the total sales price of the product is 400. The cost is 300, and of course the gross profit, which is the excess of sales price over cost, you have 100. Then the 400 is collectible in 4 months: first month, second month, third month, and fourth month. So it is delivered at the point of sale at month 0. Okay, so you debit accounts receivable 400, credit sales, and for perpetual inventory method, you debit cost of goods sold 300 and credit merchandise inventory 300. Upon collection, payment by the customer, you record debit cash and credit accounts receivable, simple as that. So as you can see, there's no installment account receivable present in the journal entries. Now, as what you have remembered, we mentioned gross profit realized at the point of sale. That's because at the point of sale at month 0, you credit sales and you debit cost of goods sold. So you have a revenue and you have an expense, a cost, which sums up to, or you have the difference rather, your gross profit amounting to 100. So the gross profit is recognized at the point of sale at month 0. Now, methods in recognizing gross profit after the point of sale. So you have installment sales method, you have cost recovery method, and for discussion purposes, we have the gross profit method. So we will discuss extensively the installment sales method. So same scenario, okay? You have the delivery at point of sale at month 0. Debit accounts receivable, credit sales. I'm sorry, this is actually debit installment accounts receivable. There should be installment accounts receivable, credit sales. Recognize the cost of goods sold in the merchandise inventory. And then at the end of the year, since we do not recognize this profit yet because this is deferred, we debit back the sales and then we credit the cost of goods sold. Thereby, the excess of deferred gross profit now becomes a liability. So if you're going to compare this with the previous scenario, before you only have this, sales and cost of goods sold. That's why you have a gross profit of 100. However, under installment sales method, after the year end, you are going to derecognize the sales as well as the cost of goods sold. So the resulting difference will be your deferred gross profit. It's deferred because it is still unearned yet. So deferred gross profit appears as a liability. So you're not going to recognize the gross profit here. So you have a deferred gross profit of 100. How is it realized? They are going to be realized as the customer pays the collection. So in cases or in transactions where the collection is uncertain um, or not reasonably certain, installment sales method is advised. So since there's uncertainty in the collection, you're going to recognize your revenue only upon collection. So you have debit cash, credit, installment accounts receivable. Again, this is installment accounts receivable. So if you will notice, there's no difference with the first illustration. However, at the end of the year, for every collection, you recognize the corresponding realized gross profit. I will discuss later how to arrive at this 25 pesos or how to arrive at the realized gross profit. So as you can see, the deferred gross profit of 100 is not realized at once. They are realized one by one as the collections are being made. Okay. So upon at the end of the year, after the collection, you debit deferred gross profit and credit gross profit. This credit to gross profit represents the realized gross profit. So as the months or years, as the case may be, pass by, the deferred gross profit decreases because a portion of this is being realized by month or by year or by whatever period. So this is your realized gross profit, and this realized gross profit will be forwarded to your income statement, added into your income statement. So how do we compute for realized gross profit? Actually, there are several ways. I will only discuss two, which is the most common. Number one is collections times the gross profit rate based on sales. Take note, I emphasize that is based on sales. Okay. Later, I will discuss the difference between gross profit rate based on sales and gross profit rate based on cost. Or the other way, you have the deferred gross profit unadjusted minus deferred gross profit December 31. Going back to the illustration, for example, you have deferred gross profit 100, and then after the first collection, of course, you debited deferred gross profit 25. So what remains after month 1 is 75. So 100 minus 75 represents the gross profit realized. So, question, how do we compute for the deferred gross profit? So the deferred gross profit is computed as accounts receivable balance times gross profit rate on sales. Now, how do we really, going back to our example, okay. How do we compute for the gross profit rate based on sales? So you have sales 400, less cost of goods sold of 300, gross profit 100. Because it is based on sale, you're going to divide 100 divided by 400. So if it was based on cost, that would be 100 divided by 300. But since it's based on sales, that's 100 divided by 400. That gives us 25%. Going back to our illustration, if you'll remember, you have collections of 100. Sorry. Okay. So you have installment accounts receivable of 400 times 25%. You have the deferred gross profit. Okay. And then for the realized gross profit, you can have 100 collection times 25%. You get 25 each. So you have two methods which can be useful depending upon the problem. So you have at month 0, the AR balance is 400. So the deferred gross profit is 400 times 25%, we get 100. At month 1, you have the first payment, so the remaining amount is 300 times 25%, that is 75. So the difference between the beginning balance of DGP of 100 less the ending balance of December 30, month 1, 75, you get a difference of 25, which represents the realized gross profit. Of course, after all accounts receivable are collected, then presumably the deferred gross profit will be realized all throughout. Now, how do we compute or how do we convert gross profit rates? So you have, as what we have discussed, based on cost and based on sales. If it's based on cost, you use 300 as your, we call it divisor, 100 divided by 300 based on cost because that's the cost. If it's based on sales, that's 100 divided by 400 based on sales. Now, how do we convert? So, for example, you're given with a certain problem, 25%. Then, another example, gross profit rate based on sales. So, how do we convert gross profit rate based on sales to based on cost and vice versa? So, gross profit rate based on cost, let's just say 25%, convert it to gross profit rate based on sales. Now, if you're given with a figure for sales and a figure for cost, a figure for gross profit, it's actually easy to determine the gross profit rate, whether based on cost or based on sales. But sometimes the problem will just give you gross profit based on cost is 25%. So how are you going to convert that to gross profit rate based on sales? So you have sales minus cost of goods sold, you get gross profit. So if it's 25% and based on cost, that means 100% is cost. How do you compute the sales? 125 plus 100, you get 125%. So what is the gross profit rate based on sales? So that's 25% divided by 125%. That will give us 20%. So gross profit rate based on sales is 20%. Gross profit rate based on cost is 25%. What if it's the other way around? Let's just say you have gross profit rate based on sales is 25% and you're asked to convert it to gross profit rate based on cost. So you have sales, you have cost, you have gross profit. So the gross profit rate is 25%. It's based on sales, and that means this is 100%. In order to compute for the cost, 100 minus 25, we get 75%. So in order to convert this one to based on cost, 25 divided by 75%, you get 33.33% or 1/3. So that's how you convert. Now repossessions. Let's talk about repossessions. Now there are times, because as what we have mentioned earlier, in installment accounts receivable, the collectability is not reasonably certain. So if the customer cannot pay its due, then the seller has the right to repossess, to get back the property he or she bought. So what happens during repossessions? So if the customer defaults, the seller normally repossesses the merchandise. If this happens, the uncollected or the carrying amount of the installment accounts receivable and the unrealized deferred gross profit is written off. Okay. So the merchandise repossessed is recorded at its fair value. The combination of installment accounts receivable and the deferred gross profit is called the unrecovered cost. So again, you recognize the merchandise or repossessed inventory at fair value. Now there are ways to compute the fair value if it's not given. You have the estimated resale price less the reconditioning cost less the normal profit margin. We will have that example later on. So upon repossession, the seller will make this entry: debit repossessed inventory merchandise at fair value, or estimated resale price minus reconditioning cost minus normal profit margin. Debit deferred gross profit. If you'll notice, this deferred gross profit has a normal balance of credit because it's a liability, it's being debited, but only for the unrealized portion. And then credit or they recognize the installment accounts receivable, again the uncollected amount. And lastly, the difference between the unrecovered cost. Again, I repeat, unrecovered cost is the difference between installment receivable and deferred gross profit. The difference between the unrecovered cost and the repossessed inventory merchandise is your gain or loss. Now, how do we know if it's gain or loss? If the fair value of the repossessed merchandise is higher than the unrecovered cost, then that is a gain. However, if the fair value is lesser than unrecovered cost, then that is a loss on repossession. This gain or loss on repossession shall be presented in the income statement at the current year. Now we'll have problem Morning Corporation, still taken from the book of Sir Zeus Milan. I suggest you buy the book. It's very student friendly. It's like the book is talking to you. So let's continue. You have 3 requirements: compute for the gain or loss on repossession, total realized gross profit, and compute for the profit. Okay, we start with letter A, gain or loss on repossession. In order to compute for the gain or loss on repossession, we're going to compare the fair value of the repossessed merchandise and the unrecovered cost. Now, if the fair value is not directly given, then we're going to compute it using the estimated selling price less reconditioning cost less normal profit margin. Okay, so the estimated selling price of the repossessed merchandise is 15,000. 15,000. Reconditioning cost amounts to 2,000. And then the normal profit margin, which is 30% of the repossessed merchandise, that means 15,000 times 30%, get 4,500. All in all, you deduct 6,500. So we have an estimated fair value amounting to 8,500. Then we compare it with the unrecovered cost. So the problem states that the property was sold in 20x1. What is the significance in determining that the property was sold in 20x1? Now, same with the previous problem, from period to period, it is possible that the gross profit rate may vary. So if it was from the 20x1 installment sale, then you need to get the gross profit rate during 20x1. So during 20x1, you have 150,000 sale, less cost of sales of 120,000, you get 30,000. So divided by 150, you get 20% gross profit rate. Gross profit rate. So this is the amount you are going to, this is the gross profit rate you're going to use. So in order to compute for the unrecovered cost, we just compare the difference. We get the difference between the installment accounts receivable balance less the deferred gross profit balance. So the installment accounts receivable balance, as stated in the problem, it was sold for 25,000 and there were collections amounting to 12,000. That means you have an AR of 13,000.
So in order to compute for the deferred gross profit for this 13,000, we just have to multiply the ending installment accounts receivable with the gross profit rate, and then we get the deferred gross profit. So 13,000 times 0.2, you get 2,600. Okay, so you have the unrecovered cost amounting to 10,400. So an easier way of computing unrecovered cost is the installment accounts receivable balance multiplied, that is 13,000 multiplied by 1 minus GPR. Okay, 1 minus GPR. So that would be 13,000 times 1 minus 0.2. So 13,000 times 0.8, still get 10,400. So the difference is your gain or loss. In this case, since the unrecovered cost is higher than the fair value, that means this is a loss on repossession. Loss on repossession amounts to 1,900. 1,900. So that answers letter A. So how are we going to journalize this if ever we are asked to? So first, we debit the repossessed merchandise at fair value. You get 8,500. You are going to close the deferred gross profit. Since it has a normal credit balance, in order to close it, you're going to put it on the debit side, amounting to 2,600 as what we have computed earlier. Then credit installment accounts receivable that was 13,000, and finally the loss on repossession, which amounts to 1,900. So if you're going to check, you have 85 plus 26 plus 19, 13,000 debit, 13,000 credit, so equal. As for letter B asks us to compute for the total realized gross profit in 20x2. Now take note, there are two installment sales here. One is from 20x1 and the other is from 20x2. So first we're going to determine the gross profit rate for 20x1. We actually determined that earlier and it was 20%. For 20x2, 240 minus 168 divided by 240, that is 30%. Since what is asked is only 20x2 realized gross profit, so we need to get the collections of the 20x1 sale during this year and the collection of 20x2 sale during this year. Take note, we are limited with this year only. Now, unlike in the previous problem, Ring Company, where the collections are directly given, here you still have to compute for it. So in order to compute for 20x1, if you're going to look at the problem, you have installment accounts receivable 20x1. Beginning balance is 90,000. Now you may ask, why is it 90,000 and not 150,000? 150,000 would have been the installment accounts receivable balance during 20x1. But because we're talking about 20x2, the ending balance of installment accounts receivable in 20x1 will be the beginning balance of installment accounts receivable in 20x2. That is why 90,000 is our beginning balance when looking at 20x2. So we have 90,000, ending balance is 30,000. So normally you would just get the difference in order to get the collections. But take note, there was a repossession. Okay, there was a repossession, and if you remember in our journal entry, we have credited installment accounts receivable, meaning this account was credited. So the credit to this account amounted to 13,000. Of course, that credit is not related to any collection. In fact, it was credited because it was written off. So the difference now between the balancing figure would be your collection. So 90,000 minus 13 minus 30, you have a collection of 47,000. So for 20x1, we have a collection of 37,000. What gross profit rate to use? 20%. What about for 20x2? Installment accounts receivable 20x2. So if you notice, there's no ending balance. There's no ending balance of 20x2 installment accounts receivable. The reason during 20x1. The reason is the sale was made in 20x2. So it is just reasonable that there is no ending balance during 20x1. So our beginning balance would be the amount debited to installment accounts receivable during the sale. So you have debit installment accounts receivable, credit sales. And how much was that? It was 240,000. So beginning balance is 240,000, ending balance is 180,000. No write-off in the given problem. So we get a collection amounting to 60,000. So you have 60,000 times the gross profit rate of 30%. Total realized gross profit would now be 27,400. 27,400. So that answers letter B. Now let's move on to letter C. Compute for the profit recognized in 20x2. So we can start with the realized gross profit we have determined earlier, amounting to 27,400. Okay, answer in letter B. And since in letter A we have determined that there was a loss on repossession, and gain or loss in repossession shall be reflected in the current income statement, then we should treat it as a reduction of our realized gross profit. So you have a loss on repossession amounting to 1,900, and that gives us our profit in 20x2. 27,400 minus 19, 25,500. That's letter C.